What's up, guys? I'm Kay Scholl. Welcome to another financial awareness video. If you're curious to start your investment journey and found your way to this video, then I'm pumped for you and I'm honored to play a small role as you start your journey. My goal in this video is simply to share some insights to help you become a better investor. I've been investing every month consistently for over 15 years, and I used to be a financial advisor myself, so I know a thing or two. In this video, you're going to learn how to start investing, some items on your checklist that you need to check off before you get started, and as well as how to have a good investment experience. Let's get to work. Okay, cool. So you're already doing better than most because in some YouTube videos, people just click out of them after the first 30 seconds. And well, you're still here. So good job and kudos to you. On that note, I hope you like the picture for this video, because if you scroll over to my About page and read up a little bit more about me, you'll see that I'm real big on setting expectations. My goal with each video is that you get value out of every video you watch. There's a very weird balance between making that picture interesting enough for you to click on, yet straightforward enough for me to properly set your expectations for what the video is going to be about. It's a work in progress for sure. All right, so how to start investing. First, log into your account, transfer over maybe $500 or $1,000, whatever you can get your hand on. Type in the ticker symbol of what you want to invest and purchase, click trade, boom, done. That's it. Congratulations. Now you're an investor and you're investing. Okay. Have you ever heard the term, you get out what you put in? Well, that's true in most things in life. And if you believe that, then you know there is a lot more to investing than just simply placing your first trade. So let's talk about that checklist. Before you start investing, here's what you need: money, a plan, time, and an exit strategy. Number one, money. Without money, you can't invest. Oh, you don't have any money? Sorry, can't invest. Come back later. Are you up to your eyeballs in debt? Shouldn't invest. But some people do, and it's risky for them, so be careful. Listen, the thing about money is this: there's only two things, that's it, two things you can do to keep more money. Number one, spend less money. Do a budget. Limit yourself. Spend less of it. Number two, make more money. Do what you can to try to make a little bit more money so that you can invest more money. The third thing you could do is spend less money and make more money at the same time. It's easy to say, hard to do, so good luck. Number two, you need a plan. Without a plan, you're just going to be investing for the sake of investing. And if you do that, you're going to fail. Why, where, how? You need to know why you're investing. Are you doing this for a long-term goal or a short-term goal? The reason why you need to know why you're investing is because the journey an investor goes through is a roller coaster. There's going to be ups and there's going to be downs. When things are going really, really well, you're going to want to revert back to your plan. When things are not going well at all, you're going to want to revert back to your plan. The reason why you're investing will either keep you invested or it will help you remove your emotions and will allow you to sell high, or it will allow you to buy low. But you have to keep your emotions in check, and you need to develop a plan around why you're investing first. Where are you going to do this? Is this through your employer-sponsored plan? Is this a SEP IRA, a simple IRA, a TSP, 401k, 403b? Where are you going to be doing this? Is this going to be a non-taxable brokerage account that you're going to do on your own outside of all those other options I just mentioned? You need to make sure you know where you're going to do this. Is this going to be at Schwab, TD Ameritrade, Fidelity, like I said, through your employer, M1 Finance, Robinhood? You need to understand the platforms and the fees involved with all of those options I just mentioned. Also, how are you going to do this? Are you going to be investing in individual stocks, bonds, ETFs, mutual funds? There is a whole collection of different ways you can go about doing this. Going back to having a plan, If you have a plan and a goal with each specific account, you actually can invest differently and have a different investment plan or an investment philosophy with each account you own. Each account doesn't have to be the same as the other. And then also, what's your investor profile, right? That's also part of your plan, because you might take a lot of risk over here and maybe not a lot of risk over here, but in your overall grand scheme of your financial planning, what is the end all goal of your plan? So develop a plan, know why you're investing, understand where you're investing, and then you can also understand how you should go about investing with each of your accounts. Number 3, time. What is your duration on this particular trade or on this particular account? Do you have a long-term time horizon or do you have a short-term time horizon? Generally speaking, the longer your time frame, the more passive you probably could be. Generally speaking, the shorter your time frame, the more active you need to be and monitor your investments. Also, taxes. If this is going to be a short-term investment position where you will be purchasing and selling this stock, bond, this asset within 12 months, you're probably going to experience short-term capital gains, which depending on your income bracket could be anywhere from 0% up to over 36%. If it's long-term capital gains, then depending on your income might be 0%, 15%, or 20%. Long-term capital gains kick in after you've held on to your investment for 12 months. Also, how much time are you going to put into this investment? Like I said a minute ago, are you going to be very passive and you're not going to invest a lot of education? You're not going to invest a lot of your time. You're just going to maybe dollar cost average every 2 weeks, every paycheck into your 401k, and you're going to set it and forget it. Or are you going to take more of an active approach? Is this a non-qualified taxable brokerage account where you're going to be investing daily, weekly, hourly, by the minute, what you're investing in? The shorter your time frame horizon, as I said, the more active you need to be. So make sure that you understand your time horizon. Is it going to be a long-term time horizon or a short-term time horizon? Make sure you have a good understanding of how taxes play a role in your time horizon. And then make sure you have a good understanding of how much your time you're willing to put into developing your investment philosophy and your investment plan in general. Number 4, exit strategy. If you're among the 20 or 30% of people that's still watching this video, this is the one component that's going to make you a better investor than you were yesterday. Literally, right now, grab a pen and paper and write down when you'll be pulling out of your trade. I'm sure you've heard about the 3% or 4% rule, but what does that mean? Do you know what that means? Are you going to pull from your dividends? Are you going to pull from your capital gains? Are you going to simply pull from your Roth account first or your pre-tax account first? Or are you going to be doing some sort of tax bracket management and pull from both so that you don't flip up to the next tax bracket when you're retired? This is very important for taxable brokerage accounts where you're probably taking a little bit more speculation. You need to write down and have an exit strategy already identified so that you can remove your emotions when making investment decisions. Same thing when the share price is going up and when the share price is going down. When are you going to pull that ripcord and open up that parachute and pull yourself out of that trade? Having your exit strategy already dialed in and on paper will help you become a better investor with better expectations. To have a successful investment experience, you'll want to properly set your own expectations in each of those areas: money, a plan, time, and exit strategy. And stay in touch with me. I'd love to hear all about your experience, no matter where you are in the journey. If you have any questions for me, leave them in the comments down below. I am sure I missed something in this video. If you are an investor and you've matured beyond the stages of being a new beginning investor, share the love. Leave a comment down below with some tips or advice that you would do differently or that you wish you would have done when you were a new investor. If you want to learn more about retirement planning, check out this retirement playlist right here. I made a lot of videos and I hope you learn a lot. Otherwise, check out that video right there instead. I appreciate your time. See you in the next one.